Dean and Tyler Listle are registered investment advisor representatives. Investment advisory services offered through Brokers International Financial Services, LLC, member SIPC. Brokers International Financial Services, LLC, and Secure Retirement Solutions, LLC are not affiliated companies.
It's time for Secure Retirement Solutions with your hosts, Dean and Tyler Listle, fully licensed retirement specialists from Secure Retirement Solutions in Green Bay. Now, here are your hosts, Dean and Tyler.
Good morning, and thank you for joining us today. Tyler and I will discuss topics that affect your retirement, such as investments, income planning, Social Security, and much more. How are you this morning, Tyler?
Good morning, Dean. I'm doing great. How about yourself?
Good, thank you. Today we're going to talk about mid-year financial checkups. It seems to be when we get towards June, July, and August of each year, people tend to forget about their finances and their investments. They're busy with vacations and with family and friends and gardening, whatever it is, but it seems to be they take the summer off. We're going to talk about a couple of things you can do just to maintain and keep front of mind all of your finances going forward. And that's going to be, just basic items that you should be looking at mid-year. Some of them you should be looking at annually, mid-year, some monthly. So we're going to talk about a couple of those items so we can keep it on the front burner and make sure that everything's on pace and running fine with your finances. So the first thing we're going to talk about is how is your budget holding up? We recommend that people create a financial plan regardless of how old they are, close to retirement, or just getting started in the workforce. Create a financial plan. What that does do is it helps you understand how much money you need to put away to schedule that comfortable retirement, that hypothetical number that you might want to get to. So it's extremely important to create a financial plan. It also takes the burden off of you by not knowing how much money you can spend or save. So a financial plan, we refer to it as a retirement roadmap. It's something that you put in writing and you can stick with it for a while. Tyler, what else should we have our listeners think about when we talk about, your budget and putting it in place?
Yeah, Dean. So with the mid-year financial checkup, first thing, see how your budget is holding up. And with that said, if you don't already have one, really your first step is going to be creating a budget. So that's the first thing you're going to want to do if you don't have one, and you can do that through a number of different ways you can do it. The first one being a kind of like an old school written budget where you write down all your expenses, what you think they might be, right on paper, and then it's going to be a little bit of guessing and checking at first because things are going to vary here and there. But if you do that for a few months, then you're going to kind of get the hang of it. You're going to know exactly what your expenses are. The other one is a spreadsheet where you can go on your computer and log it right on a spreadsheet. However, more and more commonly, we're actually seeing various budgeting apps on your phone. So, if you have a smartphone, there's certain types of apps. One that I really like, it's called Every Dollar. And right there, it's free. It'll plug everything right in for you. It gives you all the subcategories, and all you have to do is kind of go in and track your expenses and follow it that way. And for our clients, we also have different budget worksheets that we can either fill out longhand or by right on the computer as well. So first thing, if you don't have a budget, get to it. You're going to want to get one. Make sure that you can track your spending, because ultimately if you can track that, you can find that you have more money to pay off debt or more money to contribute to your retirement accounts and different things like that. So get a budget if you don't already have one. Now, if you do have one, you need to make sure that you're checking it definitely every month at first. You don't want to check it daily or weekly, anything like that. That'll be overkill. But initially, you want to check it every month at first, because if you're not checking on a month-to-month basis, then you really don't have an accurate reading of if you're sticking to your budget or not. And keep in mind, now, like Dean, like you said, with the summer months here, oftentimes people, they kind of get out of whack. They're putting their financial plan on cruise control, not really paying attention to it. But keep in mind, over time, expenses change, and you need to reflect those expenses in your budget. So for an example, let's say that, it's nice out lately here in the Green Bay area, the weather's been really hot. So let's say that you start biking to work in the summertime, and with you biking to work, you save gas money, and then you could take that saved gas money and increase your mortgage payment, your retirement plan contribution, different things like that. So over time, again, your expenses change, and you need to update your budget to then reflect that. And lastly, with your budget, don't forget to track your, as we call it, your fun money. So oftentimes when we bring clients in, we'll bring them through their financial plan, and they never account for their fun money, their spending money, just extra money that you set aside every month for different miscellaneous expenses. Because if you don't track that, you can really get out of hand with your budget and end up going way over. So you do want to have that in there, have a little section for your fun money, and use it too, because if you don't have anything budgeted in for fun money, it's just going to become such a chore, and you can't really enjoy it or reward yourself as well. Because obviously our income through work, the money that we get, we got to use a little bit here and there to enjoy ourselves. We can't be so anal about it that we're simply cutting ourselves too thin when we're younger and even when we're older as well. So number one in the mid-year financial checkup, see how your budget is holding up, evaluate it monthly.
Okay, and as far as a financial plan, if you don't have one, regardless of your work status, your age, get one. Meet with a financial advisor. For instance, anybody who comes into our office wants to meet with us, talk to us, we will create a financial plan complimentary for anybody who comes in the office. That is a wonderful thing to look at, keeps you on pace with what you need to do, what you need to put away, what your spending habits are, and so on. And as Tyler said, there are going to be certain times of year where your expenses will go down, and many times you don't plan on those things in your financial plan. So it's good to review with your advisor mid-year, have a checkup on your financial plan. Okay, second thing you can do halfway through the year, again, we want to keep our eye on investments and how you're doing as far as your retirement. Are you on goals or not? Let's look at your investment performance, okay? When we meet with clients, we give them both online access and paper statements, but at the same time, you know, we like to let them know on a quarterly basis is where you should be making decisions, okay? We always want to plan for the long term, but we want to be short-term aware. And what I mean by that is we hope that everybody has a long, successful retirement. You've saved up money for your retirement. We have to look over the long term because we are living longer. However, you have to be very short-term aware of certain situations. For instance, we're going through a period here with sanctions and tariffs being in the news every day. And that is one of the short-term situations that we have to monitor because we are making plans and changes in portfolios as a result of some of those short-term items. But again, long-term you have to schedule and think your investments are going to last as long as you last, okay? So we want to rebalance. The other thing too is you need to look at the business cycle that our economy is going through. There are peaks and there are troughs. And there are certain times where you want to have investments that capitalize on what's going on in the economy. And other times you want to shy away from certain situations based on some of the short-term situations that are going to affect the long-term productivity of the investment portfolio. Should we be making some changes? So again, the other thing you want to do is talk about rebalancing your portfolio. If you look at 2018, it's been all over the place as far as the market is concerned. We hit an all-time high in the market in January, and we have some pretty significant volatility thereafter. So you probably have some investments that are a little bit out of whack. Some of them that probably receive some very nice gains, others that might be hurt as a result of the volatility in the market. Meet with your financial advisor, talk about rebalancing your portfolio. What that does do is it takes some of your gains off the table and you can go in and rebalance the portfolio, bringing them back to the percentages that you originally started at. Tyler, anything else when it comes to your investment performance and what people should be looking for?
Yeah, Dean, when it comes to checking your investment performance, first thing, as you had alluded to earlier, we're right now in the middle of summer. People tend to get off track at this point, but it's a good time to go back in and check how your investments have been doing because we just finished the second quarter. So that's April through June. Now we're starting the third quarter in July. So it's a perfect time. You're going to be getting your monthly or your quarterly statements right around now as well. So go in there, check your investment performance, but have a long-term approach, but yet, keep in mind you want to go and look and see how you've been doing. For example, if the stock market is up 10% and your portfolio is down 5%, there could be something wrong with that. Now, again, the market right now isn't up 10%, it's closer to 2%, but at the same time, hypothetically, let's say you have a moderate portfolio and the market's up 10% at any given time through the year, but yet your portfolio is down 5%, there could be something that doesn't really add up there. Go in there, check your performance, and see if changes need to be made. If so, one of the first ones would probably be rebalancing. And what we mean by that, like you said, Dean, is over time your investments are going to get out of whack. You want to go back and rebalance to their initial allocations. So that way, if we have a down market or an up market, you're not going to take either more or less risk than you thought you were going to. The other thing, there are certain asset classes and sectors that were performing well last year that might not be doing as well now. And you're going to want to pay attention to that and keep in mind the current economic cycle that we're in. So, for example, last year, the healthcare sector finished 2017 up over 22%. And now with us being a little over the halfway part of 2018, it's now up less than 3% year to date. And that's due to the Trump administration coming down hard on the pharmaceutical companies. So again, if you kept a lot of healthcare sector stocks or ETFs, mutual funds within your retirement accounts, your IRA, your 401k, they did great. They were up 22% in 2017. If you left them there, we're halfway through 2018 and they're not even up 3% right now. So keep in mind, you never want to be allocated too heavily because there's certain asset classes and sectors that are going to perform well last year that might not be doing as well this year that you might want to scale back on. Another thing is international, and that's the perfect example of this. International funds and international stocks up until late 2016 into 2017, which they performed, anywhere from 20 to 40% through 2017. Now they're down quite a bit. But before 2016 to 2017, you have to go back all the way to 2007 to really see some substantial gain within the international sector. So keep in mind, there's the economies change over time, business cycles change. You do want your portfolio to reflect that, because if you didn't have any international holdings from 2008 through 2016, great, you really didn't miss out on a whole lot. But if you didn't have them last year in 2017, you missed out on 20 to 40% gain depending on which international funds you held. So check your investment performance. If need be, you're going to want to go in, rebalance, make changes, but ultimately you don't want to let that go. You don't just want to set it and forget about it. You can do that for short periods of time, but don't kind of just take the summer off here. Get in there, check your investment performance.
Okay, and one last thing when it comes to sectors and checking your investment performance. We've seen a lot of people this summer, wanting to know why we just don't go all in into the sectors that carry all the momentum. And when you do that, and it's human nature, you want to go where the returns are consistently and all the time. What happens is your diversification goes away, and that is riskier than you really need to be. Right now, the tech sector seems to be bouncing around quite a bit, but there's some significant gains yet still in the tech sector. So you'll have clients coming in here and investors wanting to know why their whole portfolio isn't put into tech. Well, unfortunately, that pendulum can swing the other way just as quickly. So remember, diversification is key. So we look at that consistently, but it's a good time to look at it mid-year. Okay, before we continue, we're going to take a quick break.
You're listening to Dean and Tyler Listle, investment advisors with Secure Retirement Solutions located on Allied Street in Green Bay. For a complimentary review of your current investments, or if you have questions, please call them at 920-347-9888 or go to their website at srsplans.com.
Okay, we're back to talk about mid-year financial checkups. What we're going to talk about next is reviewing your retirement plan contributions. Okay, we hope that in your career you consistently get increases in your payroll. You have opportunities to decrease some of your expenses and so on. So what happens is some people, they will go and they will have a contribution to their 401k or their 403b or whatever it is that they currently have with their employer. That's wonderful, but many times they don't increase the percentage of contribution based on the raises or the increase in salary they have over years. We tell people it's much easier to increase your contribution at the point of a raise than it is to just go in and consistently increase it when you're not getting a raise. So let's look at, reviewing your contributions. Tyler, anything else you want to talk about there as far as, the maximum and the matches, and then, possibly going back to an IRA outside of your 401k?
Yeah, Dean, like you said, you're going to want to review your retirement plan contributions now that we're, mid-year here in 2018. And also, as you said, first off, if you do get an increase at any time, you're going to want to take part of that and put that directly into your 401k, your 403b, your retirement plan. First and foremost, make it a good habit of that, because over time it's going to be much easier to increase your contributions if you can simply take a percentage of a raise and put that in there, as opposed to bumping up your current income and doing that. But either way, see if you can increase if possible. You want to aim for 15% of your salary. That's kind of a general rule of thumb in terms of how much to defer within your 401k or your 403b. And keep in mind as well, the 401k and 403b contribution limits for 2018 are $18,500. Now that's if you're under 50 years old. So the IRS allows you to defer and put a good chunk into your 401k. But then if you're over 50 or 50 or older, it actually jumps up to $24,500 per year. So they give you an extra $6,000 catch-up contribution as you get into your 50s. So keep in mind, if you're right around that age, now is a perfect time to dump as much as you can into your retirement account. Don't let that go by the wayside this summer. Pick it up this summer. Go ahead, see if you can increase. Aim for 15% of your salary. And when we talk about retirement plan contributions, one thing that we advocate is, first and foremost, if you have a match within your 401k, that's going to be the first place that you want to contribute, because it's free money. If your employer offers a 4%, 5% match, contribute at the very least up to that 4 to 5% match, because you put that much of your salary in, they're going to equal that, and that's going to come right from their pocket. So free money, you're going to want to contribute up to the match. Then after that, go into a Roth IRA. So a Roth is money that you put in after tax dollars, but then the money that you put in doesn't get taxed, and then it grows tax-free. And then when you want to withdraw it, you don't have to pay any taxes on anything that you put in or any of the gains. So not a penny of it is tax-free at that point. So definitely want to go outside into a Roth IRA. But if your current 401k or 403b, some of them have a Roth portion, a Roth 401k or Roth 403b. If they do, great, go ahead and take advantage of that, because you have higher contribution limits. You can defer all $18,500, or if you're 50 or older, all $24,500 directly into the Roth portion if need be. So take advantage of that, but obviously you want to make sure that you're putting it into the correct funds within there too, because sometimes 401ks, they don't have too many investment options, and if they have lousy funds, sure, you can put money within the Roth 401k portion, but ultimately you're not doing yourself any favors if the funds that you choose are lackluster or their performance just isn't there. So right now is a good time to go back in, review your retirement plan contribution, see if you can increase if possible. Want to aim for that 15% to salary, contribute to the match, and then anything above and beyond that, we really like the Roth 401k or a Roth IRA.
Okay. And one last thing when it comes to your retirement plan contributions, one of the biggest mistakes we see from those people working and putting money away is, first of all, the obvious one is not putting money away. The second one, and it's close, is they try to increase their contributions too quickly, and it hurts them. So what do? They go back and they reduce them, and then they don't bump them up anymore. So in order to make it so it doesn't hurt quite as much, we would like to see more frequent and smaller bump ups in your contribution. 2 to 4% increments are probably the right way to do it, unless, of course, you get a raise. If you get a raise of 5% or some number, you might want to just use all of that for your increase in contribution. But try 2 to 4% increases. You typically don't get hurt as much in your pocketbook with that, and we want to see it done more often than trying to go 5 to 10% increments, finding out that it hurts you because it's too substantial a reduction at that point.
Yeah, Dean, very good point there. And when I say aim for 15% salary, just like you said there, definitely don't go in and try and do that right away, because that usually isn't going to work. So like you said, work your way up. For example, I tell people, who are just starting out of college, see if you can aim for that, 3 to 5%. And then from there, in a few years with your raises, bump it up, go up to 7%. And then, 10%, 12%, 15%. So it's not something that most people are going to be able to do right away like that. Usually you're going to have to work your way up. And that's what we recommend as well, because like I said, if you try and do too much too quick, it's going to hurt you if you don't have your budget, if you don't have things already put in place, and then you're going to want to drop it all the way back down, and you're forever going to be hesitant bumping that up because you saw what it did to you when you went too high at first. So very important point there, Dean. Work your way up to that 15% salary over time. Don't do that too quick, but ultimately just do it in increments.
Okay. The next one we're going to talk about is your paycheck. Now, this last year we had tax reform go through, and it should have affected and will affect people's taxes when they do them at the end of the year. But also your paycheck for many people has changed, and you need to be aware of that. Some people they don't really look at their pay stubs, and they don't question certain situations. But we recommend at the beginning of the year, mid-year, and at the end of the year, review a pay stub to see that it's accurate. Again, with tax reform, your taxes might have changed. You might be taking too much now out of your payroll in taxes, or maybe not enough based on the new tax reform laws. Tyler, what else should people look at when it comes to their pay stub?
Yeah, Dean, good point there. Like you said, first off, with tax reform being passed, for most people, you're going to be taking more in take-home pay. Make sure that your pay stub reflects that. And then the other thing, withholdings and taxes, they change. Maybe you got married, or maybe you went from full-time down to part-time. You're going to want your withholdings to reflect that. You can either increase or decrease those based on different life events that happen. So don't forget to do that. Go to your HR department, get that done. The other thing, a couple basic things, make sure you have the correct hours worked and check for paid time off, because those things are easy to lose track. Oftentimes, you look at those and you think that you might have more time off or more hours worked than you actually do. And, everyone's human. There's often times where your benefits coordinator might screw that up, and you're going to want to go there and get that fixed. So just basic things like that. One of the more important things is making sure that your benefits deductions are correct. So, and this is really a big one. And what I mean by that is your deductions for health insurance, dental, vision, your 401k is a big one. But what happens is employers can screw this up at times where, let's say that you enroll in your company 401k plan and you go and fill out the enrollment forms, and on there where it shows how much you plan to defer into your 401k, your 403b, your retirement plan, let's say that you put 15%. And here what happens, you submit that to HR, and here they miss the 1, or they put in a different number, or they put in 5. So here, if you don't examine your paycheck, and also you'll notice that from your investment statements as well, but if you don't take a look at that, here you think that you're putting in 15%, when here for months or potentially even years, there's some people that don't look at any of that for 2 to 5 years, sometimes even longer. That could really put a big damper on your retirement plan, when here you're thinking that you're deferring 15%, and here it's only 5% for a number of years. You're behind. You may have fallen off your financial plan. It can really have a negative impact if you're not checking your benefits deductions, making sure that the deduction into your 401k is correct, and different things like that. Because like I said, oftentimes things can get screwed up. It's simply a matter of punching it into a computer. It happens. We see it happens more times than not. So you're going to want to check your paycheck, make sure your benefits deductions are correct, make sure your hours are correct, your pay time off is, and then again, withholdings and taxes change. So keep that in mind. Examine your paycheck. Don't let that go by the wayside.
Okay, another thing we like to recommend for your mid-year financial checkup is go and read and review your credit report and your Social Security statement. If you're within 10 years from retiring, you should be looking at your Social Security statement. Okay? You can go to ssa.gov and download your statement. A lot of people remember years ago when they received those statements all the time in the mail. Well, that doesn't happen until you reach a certain age now. So go to ssa.gov, download your Social Security statement, and look to see what your earnings are. Most people do retain their tax returns each and every year. Make sure that your tax return shows the kind of income that is also documented on your Social Security statement. If it doesn't, you need to contact Social Security office and your employer to make sure that the right numbers are reported. So go in there and look at your Social Security statements. Tyler, anything else with the Social Security statements before we talk about credit reports?
Yeah, Dean, with Social Security statements, the main thing is go in there, make sure it's correct, and really do that for planning purposes, because when you model out your financial plan, with Social Security, that's going to be your largest form of income over the course of your retirement. You want to make sure that that's as accurate as possible, because if it's not, it can screw up your whole financial plan. So go in there, check that for accuracy, use that for planning purposes.
Okay, and when we talk about your credit report, let's face it, over the last 17 years or so, the credit report has become much more important for those people, not only in their retirement planning, but throughout their lifetime to be able to purchase things. As you get older, though, and you reduce your debt, your credit report isn't quite as important as it was back in the years that you're looking to get your first house and your mortgage, and you're establishing your household with, new cars or different cars and so on and so forth. Your credit report, though, is extremely important, though, going forward, because things like your home owners and auto insurance many times are based on your credit report. So go in there and review your credit report. There are a number of agencies that allow you to go in there and find out what your credit reports are. Again, though, as you get older, don't put so much emphasis on trying to have a good credit report. I know of a client that she wanted to go and borrow money just to help her credit report, but she really didn't have a place for the money once she borrowed it. So that makes no sense to me. Tyler, anything else on your credit report?
Nope, just you want to make sure to check that for accuracy, make sure there's no errors. But then to end the show here, I'll quick run through the Midyear Financial Checkup. Number 1, see how your budget's holding up. 2, check your investment performance. Review your retirement plan contributions, examine your paycheck, and lastly, review your Social Security benefit statement and your credit report. So if you can do those things, that's a good mid-year financial checkup. It'll make sure that you're staying on track throughout the summer and heading into the third and fourth quarter of 2018.
Okay, that's all the time we have this week. See you later, and hope you'll join us again next week.
We'll see you next week.
You've been listening to Secure Retirement Solutions with your hosts, Dean and Tyler Listle, fully licensed retirement specialists from Secure Retirement Solutions in Green Bay. To get more information from Dean and Tyler, contact them at Secure Retirement Solutions on Allied Street in Green Bay. Call 920-347-9888 or visit them at srsplans.com. Securities and investment advisory services offered through Brokers International Financial Services, LLC. Member SIPC. Brokers International Financial Services is not an affiliated company.